Have you ever seen a company report amazing earnings only to watch its stock price completely tank? It can feel like the market is speaking a totally different language. Well, today, we're going to be your translator. We're going to decode the signals of the financial markets that can be, let's be honest, pretty confusing, especially for beginners. We're turning that confusion into clarity. But first, a quick and really important heads up. This content is purely for informational purposes, so this is definitely not investment advice. Your financial decisions are all on you, so always do your own homework or chat with a professional. All right, let's dive into our first big puzzle, the sell the news paradox. This is one of those things that trips up new investors all the time, and honestly, getting a handle on it is key to understanding the market's rhythm. So why does this happen? You see a positive headline, you expect a positive reaction, but the market does the exact opposite. It sounds totally illogical, right? But behind this apparent contradiction lies a fundamental principle of how markets actually work, and it's all about expectations. This brings us to a classic market saying, buy the rumor, sell the news. This phrase really unlocks a secret about the market. It's a future pricing machine. You see, investors act on speculation and rumors before a big announcement. By the time the actual news hits the headlines, all that optimism is already baked into the price. The early birds then sell to lock in their profits, causing the price to drop, even if the news itself is good. But here's the thing, not all rumors and news are created equal. In this giant ocean we call market information, there's one huge whale whose every move creates ripples. We're talking about the one institution whose every word is analyzed, debated, and traded on. It's time to meet the unofficial boss of the market. And that leads us to one of Wall Street's most powerful mantras, don't fight the Fed. It means exactly what it sounds like. You do not want to bet against the direction of the U.S. Federal Reserve. Their decisions on interest rates and monetary policy can create massive waves across every single asset class, from stocks all the way to crypto. So what guides this powerful institution? Well, the Fed operates on something called a dual mandate. They have two main goals: making sure people have jobs, and keeping prices, inflation, stable. Every single decision they make is an attempt to balance these two goals, and that's the game everyone is trying to guess. Now, the Fed doesn't operate in total secrecy. They actually give us clues about their thinking and their future plans. You just have to know where to look. So let's pull back the curtain on one of their most important communication tools. And here it is, the famous dot plot. At first glance, it might look like a piece of abstract art, but it's actually one of the clearest windows we get into the minds of Fed officials. This chart, which comes out 4 times a year, shows the anonymous predictions from each voting member on where interest rates should be in the coming years. Those different columns you see just represent projections for different points in time. So here's the key takeaway. Each one of these dots represents the anonymous guess of a single Fed policymaker. The markets look at where the dots are clustered to get a collective forecast. It's basically a roadmap showing where the people at the helm think the economy is going and what they plan to do about it. It's an incredibly powerful tool for managing expectations. Okay, so even if we have tools like the dot plot to understand the external forces moving the market, there's an even wilder force in play, the one inside our own heads. When volatility is high, the biggest challenge isn't reading the market, it's reading yourself. So let's talk a little bit about investor psychology. During high-stress times, our brains can play tricks on us. We might fall for herd behavior, just doing what everyone else is doing. Or we might make a flight to safety, selling everything for cash at the worst possible time. Another common trap is the disposition effect. That's when you hold on to losing investments for way too long, just hoping they'll bounce back. Recognizing these biases is the very first step to overcoming them. So, if our own emotions can be our worst enemy, how do we build a portfolio that can withstand not just market swings, but our own psychological traps? How do we play defense? Well, we can start by having 2 different playbooks. Think of strategic asset allocation as your ultimate destination on the map. It's your long-term plan based on your goals, and you generally stick to it. Tactical asset allocation, on the other hand, is your ability to adjust the sails along the way. When a storm appears on the horizon, a tactical shift lets you make short-term, data-driven adjustments to navigate the choppy waters, all without losing sight of your final destination. Part of playing defense is also knowing where to find stability. During economic downturns, investors often rotate into what we call defensive sectors. These are the industries that provide essential goods and services, stuff people need no matter what's going on. Think toothpaste, electricity, and medicine.
Because demand is so steady, their revenues tend to be more resilient when the economy is struggling.
So, as you can see, the market isn't just random chaos. It's a complex system driven by expectations, data, and human psychology. It prices in the future long before it becomes the present. The key is to listen, not just to the news, but to the whispers that come before the news. Which brings us to the real question. Which rumor are you going to be listening to? To learn more about understanding the markets and to boost your financial literacy, don't forget to visit usmarketinvesting.com. Thanks for watching.